In 1990s, Japan had one of the greatest real estate bubble in the history. Property prices in Tokyo were so high that the Imperial Palace grounds were said to be worth more than all of the real estate in California combined. But then it all came crashing down. The bubble burst and Japan has spent decades trying to recover from it. The question is, could Canada be heading down the same direction or the same path? Now, to really understand why people are comparing Canada to Japan, we first need to go back about 40 years back to Japan's real estate boom of 1980s. Now, during this time, Japan was an economic powerhouse of the world. Its manufacturing sector was booming, its exports were dominating global market, and wealth was pouring at a new record speed. Banks were lending freely, interest rates were low, and the credit was really easy to get. And this combination triggered a frenzy, not just in the stock market, but especially in the real estate market. Property prices, particularly in Tokyo and Osaka, began skyrocketing year after year. And in 1989, the Japan stock index has tripled in just 4 years, and the land prices had soared to unbelievable levels. A common saying at that time was the land under the Imperial Palace in Tokyo worth more than all of the real estate of California combined. And it wasn't far from the truth by some estimates. Commercial land prices in Tokyo Financial District has risen over by 500% in less than a decade. And this wasn't just a normal boom. It was a full-blown asset bubble. Speculation was rampant. People were buying land not because they needed it, but because they were convinced that prices could only go up at this point. But in the late 1980s, the Bank of Japan started to worry. Inflation was creeping up and the asset prices were clearly out of control. And in response, they raised the interest rate sharply. And from roughly about from 2.5% in 1989 to over 6% in 1990s. And that was the pin that popped the bubble. Within just a couple of years, the land prices in Tokyo dropped over 60% and the stock index crashed by more than 70% from its peak. The wealth that was created on the paper evaporated almost overnight. The consequences were severe and long lasting. Banks were stuck with bad loans, bad debt, consumers stopped spending, and businesses scaled back. Japan entered what economists now call as the lost decades. More than 30 years of low growth, near zero interest rate, deflation, and a stagnant property value. And even today, many of the Japanese cities have property prices below their late 1980s. Now let's understand why this matters. The story of Japan shows how quickly an overheated real estate market, fueled up by speculation and cheap borrowing or cheap credit, can spiral into a major economic drag when condition changes. And that's why so many experts are asking if Canada might be heading down the similar road because we have so many similarities that happened back in Japan, what happened in Canada in last 5 to 6 years. Now let's check what are the similarities between Canada and Japan which could lead to a devastating economic cluster. Now, the very first one in this one are the debt level. The Canadian household owns over 180% of their income or disposable income, and Japan had very similar debt excess pre-crash. So, what I mean by 180% is like if you are earning $1, dollar 80 is going to of your disposable income going towards the debt, which is not good at all. And we have seen in the past, like the household debt levels in Canada are among the highest in the world, especially when we consider G7 countries, we are at the highest. The second point, which is very important in this one, is the housing overvaluation. Some estimates that Canadian real estate are at 30 to 40% over its fair market value or fair value. And we all know what happened in last 10 years. Like real estate prices have escalated so quickly, especially in 2021 and 2022. And we have seen some drop happening after 2022 mortgage interest rise in that one. But still, it's very far from the affordable level as of right now. Now, in 1990s, the average Canadian house cost roughly about $120,000. That was roughly about 2.4 times an income of an average family. Fast forward to today, the national average price it is about $664,000 based upon August of 2025 report, and that's about 9 times a median household income. Practically speaking, if you had 20% down, a 25-year mortgage, And a typical mortgage rate back then, the qualifying income you'll need was roughly about $34,000 a year. And today, you would need around $96,000 a year to comfortably qualify, and the median household income is only about $74,000. And that gap is why affordability is now a national conversation. The third factor in this one is the aging demographics. Now, Japan had an aging population. Canada is on the same path, though it was mediated by immigration. Now, immigration fueled the rapid demand in this one. Canada has brought 472,000 new permanent residents in 2023, which has been a meaningful component of the housing demand. But the government has already planned to reduce that target by 395,000 people in 2025. And that flow is the major reason why Canada price dynamics differ from Japan's 1990s experience. And the last in this one is the policy dependence. Now, Japan relied on stimulus to prop up its economy. Canada already leans so much heavily in real estate for their GDP growth. If you haven't checked my last video, it does say how Canada and GDP, I mean, Canadian real estate and GDP is very well interconnected, and why we should not rely heavily on real estate for our GDP growth. Now, let's check out some of the differences why this crash could not happen in Canada. The very first one in this is the Canada's immigration policy, which is very unique and constantly adding up the new demand. The second in this one is the Canada is a resource-rich economy. So energy, minerals, while Japan was not that much resource-rich country. The third in this one is the global capital inflow. So what I mean by that is like Canada is seen as a safe haven for many foreign investors. You might not be seeing that on a ground level because foreign buyer can happen in a real estate, but on a commercial side, it is still happening. And the last and the very important in this one is the government is more proactive. We have stress test, CMHC rules, rate adjustment, which you are seeing all the rate adjustment happening with Bank of Canada announcement every 2 or 3 months. Now let's check out what are the risks ahead and what could happen, like how Canada could go into a Japan scenario. Very first one in this is the prolonged high interest rate, which is squeezing borrowers. The next is that if immigration slows down, the demand shocks, and this is something which we are already seeing on the rental market based on the recent report. Like for the past 12 months, rent is going on a downward trajectory. The other is the over reliance on housing as an economic engine, which include construction and banking system. The next factor could be the rising government debt, making intervention very hard. Now let's check out what this means for a buyer and investors out there. So for buyers, don't always assume that the prices will only go up, especially in real estate. We all have seen what happened with Japan and also what happened after 2021, 2022 interest rate hike. Like prices came down crashing roughly about 20 to 30% in some cities. For investors, the primary thing is the cash flow matters more than speculations. Like many times investor works based on appreciation, but cash flow is the number one thing, and that is again based totally on my opinion. However you want to structure your investment deal totally depends on you. So do you think Canada will become the next Japan? Now, history never repeats itself exactly, but it often leaves the pattern. Whether Canada faces a crash, a slowdown, or a continued growth depends on how we balance that. Thank you so much for watching. I hope you like this video. If you like this kind of content, please subscribe to my channel and I will see you on the next one.